Chris Kelm from San Antonio, Concordia Lutheran. I guess I've been a member there for about 20, 25 years. But what I'm really speaking on today is based on utilizing the tax advantages you have with your housing allowance, your pension, your 403B, all the different options you have that are available that we can use through your CPS, and also the benefits that have changed since June of last year, or June of 14, and regarding the retirement. I'm not a CPA or attorney, so I'm a financial planner, so that's I'm off the hook on some of this stuff. I do speak on a regular basis in Washington, Capitol Hill, for the Senate Finance Committee and House Ways and Means on different topics relating to tax reform, issues affecting our industry, so that these issues, especially retirement, with our current administration, they want to make some changes that aren't very positive to anybody for retirement. So we do that on 3 or 4 times a year. Go speak to those people that supposedly make the decisions, even though they don't really know what they're making decisions on. Actually, I'm a preacher's kid, so this is what got me involved in doing this, and really was a selfish thing, was to make sure Dad was saving his money. And it ended up being that Dad didn't really understand what all the advantages were to housing allowance, the pension, and so forth. So what we did was, as a selfish thing, was I wanted to make sure I wasn't going to be taking care of my folks. And it worked out where I didn't have to. But so for 20-something years, I handled their accounts and learned quite a bit how it worked. And housing allowance, you should always have a mortgage, a big mortgage, as big as you can afford, which that makes a lot of sense to a lot of people. But when you really look at it, is with your housing allowance, you can write off almost anything pertaining to the house. With interest rates the way they are now, I was downstairs talking to the Lutheran Church Extension Fund. I didn't realize they just loan money to people in the ministry. The rates were 3% to 4%. You can put 5% down without a PMI. That just doesn't happen. So you can get into a house, a nice big mortgage, as long as you can afford the payments. That helps too. But what we did with my father was he paid his house off early and lost his benefits. And not really lost his benefits, but it becomes rental property. So when you start looking at rental property compared to maintenance and all the other stuff you can include, you need to have that big mortgage. You're writing the interest off, so at a 4% note, 25% tax bracket, that's a 3% cost. And then you're using it as a housing allowance. So your net cost on having the mortgage is very minimal, and having it build up equity, the funds in your equity doesn't build up any interest. So the money you have sitting in equity is not doing you any good, especially in y'all's situation. And it works outside, but it really works well for y'all. This is your largest tax deduction, and it can be substantial. And one of the other things you can do, we talked about with 30-year, people talk about they want a 15, 30-year note. Take the 30-year, get the interest rate. You can always make additional payments so you can bump up your housing allowance. And by doing that is you can make sure that you use it all. But you want to pass those things on now? That's a list of an updated list on everything you can write off for your housing allowance. And if you really, after looking through my dad's receipts after he passed away, he wrote everything off. And it worked out well for helping you stay in the lower tax bracket. And when you look at talking about writing 22, 3,000 a month off, taking that off the top of your mortgage is substantial. We can get into some tax bracket planning where you can get down to the lowest tax bracket of doing some tax-free alternatives to what y'all are doing with your 403B. Are any of y'all still contributing, or any of your churches still matching? Your church matching? They just continued 1%, so they just reduced it down. Really, the 403B is a wonderful vehicle when they're matching, because you're getting a 50% rate of return as long as you're up to, no matter what happens, when you're matching dollar for dollar. But when you look at your overall benefits, and I don't know if y'all are familiar with mycps.org. If you go to that site and go down to Retirement Connection, you can plug in and play with all your, put different scenarios in and play with when you want to retire, and it'll break it out for you. And then after we get those figures, we can also, when we look at the 403B, we can tie it together to see where you can stay in a lower tax bracket. And like I mentioned, using some other vehicles to keep you in a lower tax bracket. The pension you have is as good as it gets. When you had the changes in 14 where you just couldn't retire early, but in the private sector, you can't get it. It doesn't get any better. The survivor supplement retirement account, that's frozen, but that was just a bonus anyhow. The fund has performed so well and is managed so well that they're going to continue the cost of livings for, that's been planned for the next 20 years for actuarial purposes. So you're going to get your cost of living once you retire, and they have figured it at 3%. So whatever, it used to be adjusted by what actually cost of living was, but it's a fixed amount at 3% once you start taking your income. Regarding the, another way, when you pull up your, a lady asked me this the other day, was how much is my pension really worth? And if you take your, it's all done by, shows a monthly benefit, but just take your top one, multiply it by 12 and divide that by 5. $50,000 a year pension is worth $1 million. 5% is what they use for pension calculations. So, and reality is you can actually sell your pension. The return on it's not that good, but you can sell it for about 2/3 of what the value is, as long as you're going to live long.
Mr. Kelm, can we assume that the clergy housing allowance would include ministers of the gospel, rostered church workers, or is that separate and different?
No, I should have brought that up. No, it covers any called workers.
Okay.
And you bring up ministers of the gospel. When we were in D.C. talking, that's been an issue that's been coming around, that they're going to start doing away with the housing allowance. Well, in 2002, it was revisited. When let's see, it'll be 2 years ago, we met with Bankus and John Rockefeller, who were head of that portion of it, and I asked them about housing allowance, what's their plan for it, and they figured out that y'all don't make as much money as they do, and so the percentage of it wasn't going to be as high. And so basically Rockefeller just basically said, I'm not going to get God's people mad at me, so that one's off the table. So that one's taken care of for a while, but it's not going to change. The only thing that could change is, you mentioned the gospel. That's going to be the next thing they're going to hit. Is there's a big difference between gospel and some of these other folks out there that are parlaying it into a tax benefit. And but for y'all are in great shape with it. They're not going to mess with it because they see the dollar amount. And also it's y'all's biggest benefit. Uh, before I get into the pension max, you know, one of the things, growing up as a PK was, my mom never worked, and that was one of those deals that wasn't gonna happen. And we followed suit. I figure if Dad could do it on his income, we could do it on ours. And we have, but, you know, a pastor, we were visiting about this the other day with the seminary, regarding the seminary students. These kids are coming out with big student loan debt. Then they're coming out making 30, 40, I heard, thousand a year. You can't live off that. And you know, a pastor ought to be paid enough where his wife doesn't have to work, and it should be, in my opinion, should be enough that she can stay at home, take care of the kids, and not have to work to maintain their level of income and take care of the physical needs of the family. You know, that's the congregation. When it comes to the calling in a called worker or a pastor or whoever from the seminary, if you look at that student debt, these kids aren't even paying the interest on it. So you're looking at a 15-year note in many cases. So one of the things we brought up was it ought to be that if a congregation calls somebody and they come in, the congregation ought to be responsible for paying just the interest on the student debt, so the minister doesn't get behind, because the interest is is 25 to 35% of what ends up being the loan, even though they don't realize that when they take it out. Nobody tells them, you know, the interest is going to be due. So, you know, you're looking at having, the one we saw was 82,000 in student loans, and the debt was 121. And so when you look at their original payout, when they put it together, was based on the 80-something thousand in debt. Well, it's not even close, and that's what the kids are paying. So you're going backwards. So that was one of the things we've brought up, is having the congregations help with at least keeping them even, and or they have to match it, something like that. But at least have an opportunity to keep these guys from going, you know, leaving the ministry because they're going broke. And that has become a bigger and bigger issue, that if a church can't afford to pay somebody, and I think we're talking about $50,000 a year. I don't know if that's where that figure has come from, but it makes sense to me that guys shouldn't be on the fast track for poverty when you get out of the seminary. Now, some of them with the student loans, I heard one guy bought a car, which makes sense. You can't go get a loan when you don't have a job. And then if you can buy a car and not have to pay for it for 4 years, it's a pretty good racket. But that's what's happening with this. They're not being monitored. And the kids are leaving college and going into seminary with so much debt. When you get into the housing allowance, you know, it's not explained. The seminary and colleges don't do a very good job of explaining what you can do. If you look on that list, you can write off, I mean, almost anything to do with the house. No longer toiletries, which was, you know, I didn't know why they had that to begin with, but any maintenance on the house, anything you do regarding upkeep, mowing the yard, so forth. So you can really beef that thing up by even adding an extra payment or two. And that's where you get, well, like with my dad, my mom wouldn't spend enough money on the remodeling. So he would just have to make extra payments at the end of the year just so he wasn't going to get taxed on it. But one of the other pastors I was talking to the other day was completely redoing his house, and he said, how much can you write off? And it's 100%. You can't do that I wouldn't think you could do that very often and live very well, but you know, if you're putting away the money to remodel and based on your salary, that's not a bad deal, not having any income.
Can I ask a question?
Any taxable.
the additional money that you're talking about paying a mortgage, so if your mortgage payment was $500 and you're adding a $500 principal payment to that, that is all part of the housing allowance, that thousand?
Yeah, anything you've paid in as a payment to the mortgage company.
Okay.
So the main thing is just keeping the receipt, good records and avoided check, because it's still considered part of your housing allowance.
Oh, where were you 3 years ago?
Well, the one guy I talked to the other day, he's been in the ministry 31 years and didn't realize he could write off his fence, or some other things.
Chris, have the law shifted in any way in that, can you declare the housing allowance at the point in which you're filing your taxes, or you have to declare an estimate of what you're going to spend for housing allowance going in?
You have to do it upfront going in. It's usually done in November, December, and so you need to really project what you're going to do if you're going to do any remodeling or and like with my folks, my mom never got around to doing stuff, so Dad just was making payments to offset what she didn't do. But you know, you can only do that for so long. But what we were doing with Dad was refinancing, get his house paid for, and so we would go and get another loan, set it up on a 5-year note, and he was making payments. And you know, the thing, when he would set that up and he would get $100,000 from it, he would give me the money and I would invest it and do some things with it. Well, if worst case came about, was he could always get to those funds to pay off the mortgage. And so all you're really doing is letting Uncle Sam help you with the tax deduction on using that money. And so we refinanced 3 times before he passed away, and just kept it going. And you know, with these rates, you know, you have a rate, you're netting out 3%, and then you take your housing allowance out of it. Your cost, depending on your tax bracket, could be 1.5%. And if you know, some of the vehicles we use have a guarantee of 7.5%. That's not, you know, 5-6% on your money, so you're just leveraging your dollars. And it even works if you don't have a housing allowance. Obviously, the numbers aren't as high, but just, you know, people in their 60s, 70s are getting 30-year mortgages. I think you can even get a 40-year, but you have to be 50. And the other thing is the 403Bs. We've started looking more at those because you look at your pension plan, it's taxable. All of it's, you know, it's taxable as income. Your 403B is taxable as income. The survivor or supplement, retirement account is taxable. So, and what's going to happen is Social Security is going to become taxable, and that's the thing that they're saying now is we've been concerned about. Are you going to get your Social Security? You're going to get it, but it's going to be, you know, it's already taxed at some degree, but it's going to become almost 100% taxable, just like if you were getting a pension account. So the government can say that they're giving you your full Social Security, and then they're talking about cost of living. Well, they didn't even give a cost of living this year, but they're still showing projections of you can get a cost of living on it. So when it comes to the Social Security, we just basically take that figure of what they're currently showing with no cost of livings and use it. Depending on your age, if you're retiring fairly soon, it'll be pretty close. But cost of livings with the Social Security are probably going to be gone. And then with it being taxable, you really, I mean, are getting hit pretty heavy. You know, instead of when we saw $3,200, they're going to end up getting $1,800 of net income out of it. So the people that are planning on using that, you know, the pension was designed originally before they made changes was to provide 70 to 80% of your income when you retired retired including the Social Security. Well, now that's not the case. It's closer to 60 to 70%. So you're going to have to, it's going to have to rely on you to come up with more money to keep the same level of retirement as what was projected however long ago when you got in the ministry.
Did I hear you say that the primary benefit, retirement benefit from Concordia plans is taxable?
Yes, it's.
But it can be reduced by the amount that's used for housing.
If you're, yeah, when you're retired, what you can do is, whatever congregation you retire from, you keep your call with them. They can designate your retirement account, whatever part you, all they have to do is designate your retirement account as eligible for housing allowance. So
Concordia does that.
Yeah. I think-
Concordia has already designated it 100% housing.
Oh, so they've already
Congregation
done
doesn't
it?
have to.
Yeah.
Okay, well, the guy up in St. Louis said that wherever your call is, you have to do the paperwork to say that if you're active.
No, if you
So-
retire, I'm saying if you retire.
Well, yeah, most of the ones we've been working with, I don't know very many pastors that really retire. I mean, they die in the saddle. And, you know, as long as you work, you can bump around doing anything ministry-wise. As long as you're doing something 21 hours a week, you're active. And so you're eligible for your full housing
But I
allowance.
don't think you have to. I think you can be fully retired and consider whatever you spend on housing as housing. You just write it off on line 16 of 1040.
That's correct.
What was used for housing, and that reduces the amount
Yeah.
that your pension is.
Yeah, exactly. And
And if I could interject, because I want to make sure that if you're an active worker drawing retirement, none of the retirement is housing. You can't have it elected. Only what your congregation pays you
That's
can
right.
do elected.
Right.
yeah,
So
until
once you retire and draw, then it's 100% housing automatically.
But what would, you know, like I said, you die in the saddle. You know, even if you were to cut back in 50%, normally it better be more than your housing allowance, or I wouldn't be doing it. But yeah, the active part is once that it switches over. And I didn't know they did it automatically because, but yeah, it just switches in at that point when you're inactive. That the your pension now is your income. So all it does is revert back to that. You're still active, you're getting it on both sides, but like you mentioned, you can't get it, you only get it so much housing allowance and it's based on your actual income that's coming from the congregation.
Would you speak to the fair rental value limit on the housing? I think that's important to understand too.
On the fair rental value,
Yeah. Housing is limited.
or
To what?
if you're renting your property,
No, if you own it. The amount you can deduct is limited to the fair rental value of your home.
no, that's only pertains if you're using it, your house is paid for, then it goes to the rental value of what you would be getting.
You have to calculate the fair rental value, and that's your maximum that you
They
can
can't
deduct.
exceed that amount. In other words.
Even if you spend more, even if the congregation designates more, that's your limit. Fair rental value.
Well,
That was actually the change they put in 2002. They clarified that.
Well, that's the first, I don't know anybody that's doing it that way. It's all based on what you're spending and the amount because they say you can go up to 100%. On my website, we have the IRS, it's kelmgroup.com, and you go under Pastor 360, and there's 3 articles on it, and it basically it's up to 100% of what you spend on your house, or 100% of your income. So, yes.
We were just told what he said. He did our taxes up till this year.
Right,
And
and then
now?
we were told we need to have the fair rental value in there because I had been doing it incorrectly. And he said it must be there because you need to compare that to
your housing
Or
allowance.
spending.
You have to have a number
It's a
there. Yeah.
three-tier test, what you actually spend, what you have as a fair rental value of the
Designated.
home, furnished with utilities, or what your governing board designates. So it's the smallest of those three.
Correct, and that they use against what you actually spent on your
Right.
housing expenses.
Well, the way at Concordia, it's done we've done it for Dad, it was never, it was the congregation, it was not set what the amount was. That was determined by the pastors. And I've just never seen it that way. So, that's new to me. Have you seen it that way, Terry?
Usually what I've seen is that, the congregation will make a declaration in November, which will allow you to deduct up to 100% if you can justify. They don't recommend you do that on an ongoing basis because it's applying to the IRS. But at the same time, as an employee, you're required to designate a certain amount of what your salary is going to be applied to housing. And then that shows up on your W-2 at the end of the year.
When you say
It's one of the
you're talking
ones.
about for the next year? For the next year.
And so, my understanding, Chris, is that you can adjust forward, but you can never adjust backwards.
That's correct.
Yeah, that's what we've always had, been told, that you have to declare it in advance.
And that's what I was talking about, the makeup, where if you're planning on doing remodeling, you need to plan that in advance, how much you're gonna spend. And that's what's reported to the congregation as your housing allowance. The fair market value, I don't know where, I've just never
I
seen.
suggest you take a look at the code.
Yeah.
Code section actually says what you actually spend to the extent it does not exceed the fair rental value of your home plus furnishings and utilities.
Now, if you live in
So-
Scottsdale, that fair rental value may be a lot higher than if it was.
Yeah, it's different by part of the country.
And who determines that fair rental value? I don't know. If you ever get audited, I suppose you have to have some basis
Yeah.
for.
We were told to call someone.
Yeah, we were told to get a
number.
realtor so at least you have some accuracy to your number.
Fully furnished with utilities, the fair rental value in your neighborhood. You can't declare more than that, what that is.
I used an organization that's called Clergy Advantage, which works primarily only with people that are in church backgrounds. And they never require preachers. And that was up until 1 year ago. Now, they're professional CPAs working only with clergy. So if you're not working with somebody who really understands the clergy, and they're just a traditional CPA, then you may want to look at somebody who actually has a lot of clergy background versus just a traditional CPA.
Yeah, and, if that's how they read the code, Dad went through 2 audits. He lived in West Texas and his housing allowance was fairly substantial, and that wasn't even an issue. The issue was his tithe was too high. Which is a nice problem to have. I guess that's why they did so well, but, I'll look into that, but I haven't, I don't know anybody that's doing it that way. We've never come across that's even been, brought up. And, the CPAs that we've worked with, I worked with a different firm in, San Antonio that does it for some of the bigger congregations, and they just do the same thing. It was up to 100% of it, there was never a fair market value. I don't know how the only thing I've heard regarding that was a second home. When you're trying to, which is sort of playing up, if you get audited on that, you're in trouble anyway.
Yeah, second home
So it
don't
doesn't
count
matter.
anyway.
But I'll check into that, cause I've just never heard that's, doing it for.
Well,
that.
as it was explained to me, the reason they went to that 3rd test of the fair market value was because some guys were buying a second home and taking 100% of their compensation and applying that to housing for that second home.
Yeah, the second home thing went in 2002 is one
Yeah,
of
that
the
doesn't
things
qualify
that.
anyway.
So that went away.
Yeah, that's what
Okay.
that was one of the things that came up was, some of these guys on TV had 2 or 3 homes.
Right.
And as long as it was under $1 million, you were fine. And that was the cutoff point. But, moving on to your, your pension plan, the supplement retirement account was frozen. And like I said, if you pull up your benefits on there, it gives you a breakout of the SRA, and if you, on some of the sheets it cuts it off, but if you go to the second page, there's a lump sum. And the lump sum, if you take the lump sum, you can about double what they're gonna pay on it. And plus you can leave a legacy with it because you can use an annuity vehicle to, and keep it in your name. If you do it with, keep it with, as a defined, well, it becomes a defined benefit plan, just like your pension plan. So, people we've looked at it and calculated it back and forth, you're always better to take the lump sum, control your money, and, whatever you actually don't have to start taking that income, you have more control when you take it. Because once you're retired, you're retired. And the, part of the, then you have your the 403B, which most people at this point, very few people are contributing to it because they're not, the match isn't there anymore, and there's other things you can do that aren't taxable. And when you start looking, depending on your age, and we've done 8 cases in the last month, if you really start looking at the difference between age 62 and age 67, what your payout is, it's not that 5 years isn't that high. You're better off taking, and for example, I have one that my office just sent me earlier today was that we finished up was client 61 retires at 62, his benefits $3,213 a month. 67, it's $3,516. So, you're looking at $303 a month more by waiting 5 years. That right there in itself is over $150,000 that you can even do in an annuity that would pay more than the benefit of waiting the 3 years. So we are having more people look at, now they're not retiring, they're still active, nothing changes, they're still plugging along, doing their thing in their church, but they're considered, they're drawing their pension, but they're active in the ministry. And
I just attended a retirement workshop with Concordia Plans, and I've heard for the first time that you can take your pension while you're still actively serving, but you can't do that until you're 65. And what they call an in-service retirement benefit. So you're still working, you're drawing your income, but you're taking your retirement a year before full retirement.
no, 67 is a full retirement now, based on how long, depends on your, if you met the age last year, what was it, 2014? You had to be 57, 58 to get the formula of 85. But yeah, the 62, the 65 is what they talked about for years, but 67 is the new retirement age to get your full benefit.
For Social Security? 66 for me, but I mean,
Yeah,
it's going up for younger guys.
Yeah, but for the pension, that's what it's based on for the, is age 67. And if you run the numbers.
It's full retirement age, whatever the Social Security one is.
66.
Yeah, but, yeah, well, it depends
So
on the.
it'd be 66 for
For
you,
me,
it'd be
66.
67 for, yeah, it depends on your age.
Yeah, so what I'm looking at is picking the retirement age depends on your age. I'm talking about a 61-year-old. So, if you meet that number, like for someone my age, it's 67. I'm 52. So if you made that point or you cross that in June of 14, I mean, my dad retired at 61 with full pay, stayed active. I mean, didn't leave his church. Only 2 people in the church knew he retired. And it took me a year before I could get him convinced to take it because he thought it was double dipping. And, but, you know, you look at people in the government, you know, once you get your time in, you're eligible for it. Whether you retire or not, that's up to you. Congregations, very few congregations want the guys to leave. If they do, they would have encouraged it sooner. But, you know, we probably have 20, 25 different pastors that are just, nothing's changed. They're drawing their pension and just keep going. Some of them are working at the universities now, teaching in the seminaries and so forth. So that's, you're eligible to get to your pension. What you do, if you want to stay active, if you take it early and don't stay active in the ministry, you lose the health insurance. You have to start paying your own health insurance. So, you know, there are benefits to staying in, but if you're just going to shut it down, you just shut it down. But you want to make sure you're getting your full benefit, because once it's set, it's set. And then the survivorship is 100. You look at the numbers, the only way you do it's 100%. I mean, the difference is minimal for your spouse. So, but yeah, I mean, the being able to take it early and continue going on. The key is, you know, once you take it, that amount is set, except for cost of living, and which is the 3%. But being able to take it and continue working, that's up to the individual. But some people don't want to keep working, and they just take it. But like I said, I don't know very many pastors that aren't in some form or fashion. How old was Ebbs? In his 80s.
He still
and he
is.
was still still alive then. Well, he just moved, so he is gone. But,
He moved back.
oh, he did.
He's in
Oh,
San Antonio.
his wife passed away, yeah. But he's been drawing that since Dr. Merkins was at Concordia. So, you know, when you look at the numbers, the difference in taking it early and waiting 5 years, it makes no sense to wait that extra 5 years as long as you're going to stay active. And just run the numbers and check it. I mean, just compare it. And like in this case, it's $300 a month difference from 62 to 67. You know, that, what, $75 a month to hang in there for another 5 years. And you could take it and start using it. Well, what my dad would do, and you know, there was a handful of the guys that went to seminary at the same time. They were taking it, and then they were using paid taxes on it because it is taxable as income, and then they were investing it. So what they were doing was we would set up different accounts so they would make up the difference, and you can actually do, depends on when you what you put it in and what you're looking at is 3 to 4 times the makeup of what you would have gotten. So there's no, you know, if you're going to stay active, 62 is a great, and that for some reason that's the figure that when we played with it, and I've talked to the guys up in St. Louis, that's the figure we came up with where it was working. The 62, you do 61 and it's a pretty big drop. But between 62 and 67, there's not much of a change. So
that's the traditional route of being a pastor, but for second career, that might be quite different.
yeah,
since you start so late.
Yeah, that 32 years to 33 years is really, you know, my dad had 35, but yeah, 32 to 33 years in the ministry, and then that's when the benefit at 62 works. You know, coming in late, obviously you're not, you know, it's still based by years. All they did was extend the dates back, and 85 is no longer active for everybody. It's back to Social Security. But, you know, when you look at that and that's an option, and the plans we put together to maximize your pension, it's substantial, the difference it'll make. And and most of the guys want to stay active. I mean, it's a calling. They want to stay active. They want to be doing something in the ministry. Also, they want to keep their housing allowance. When my mom passed away, she passed away 10 months after my father, and we were she passed away. Dad passed away Easter of '10. Mom passed away in January. The difference in taxes, because losing the housing allowance, was $12,000 and something dollars. So that's another thing about getting into insurance. You know, people talk about, I don't need life insurance after a certain point in time. You know, you look at what Mom would have had to pay in addition. Her pension didn't go up. It stayed the same, 100% survivorship. Also, Social Security was reduced. So you start looking at what she lost and what she's going to have to pay for taxes. It adds up rather quickly. And people don't realize that, but if you start adding an extra $12,000, and then with your Social Security drop, that's $15,000, $16,000 a year that she was going to lose in benefits. Now that was only an 8-month period, so I don't know. She passed away in January, so it wasn't like we had a whole lot of time frame to compare it to. But so that's another one of those things to consider is the house. You know, when you're used to budgeting off a housing allowance and it's gone, there's a big change. And Mom didn't want to leave her house, and you don't want to have to force your wife to, you know, remarry. Well, she wasn't able to remarry, but you know, have to make a decision on where she's going to live. Dad we had her in great financial shape, but a lot of folks don't have that luxury of where she didn't have to live. So, you know, the life insurance portion, that's all determined on whatever you're going to calculate what you're going to lose. Also, a legacy. We talked when you start retiring at 62, we can fund some of these insurance contracts that are designed to build cash accumulation on a tax favor basis. I mean, there's 4 or 5 companies that have contracts that are designed to accumulate money to provide tax-free income. And the tax-free income comes about from Section 7702 of the IRS code, which has gone back since 1913. So you can use these vehicles, and if you're using tax-free money, like in this case here, the death benefit, when we funded it was $1 million. That $1 million takes care of a lot of expenses, but what was more important was, you know, when you die with a pension, defined benefit, it's gone. And what we can do is leave a legacy to the kids. So you can keep that pension is not gone. You have maximized your pension so that there is a lump sum value there, whatever it is, that will go on to pass to your kids, grandkids, which, you know, defined benefit is based on income stopping. The way we had done it for my father was there was the money there for Mom. I mean, she didn't get to enjoy it. Well, she didn't need it, but she didn't get to enjoy it, but it was there, and it's going to my grandkids. So it's something that wouldn't be there if we hadn't done this. And with Dad's income, and like I said, we refinanced 3 times. So he did this, went through the audits, and we just refinanced. Now, it wasn't anything, he was refinancing basically what he was paying before. And so he just kept his payment going. And so we invested in it over an 11-year period, and the amount of money it accumulated was quite a bit. And unfortunately, unfortunately, we had to take it as a death benefit, but, so his pension really, when you look at it, has gone on and continues to go on. Really that, you know, it's, the numbers work, you know, the people in St. Louis understand it, they don't like it, because now they're looking at too many people retiring earlier, starting to take their pension, because they're starting to run the numbers. You know, before 2014 in June, there was a big difference in 62 and 67. And it wasn't, or 65, I should say, in some cases, that's what it was based on. But Dad took his at 61, either 61 or 62. It took a year to talk him into doing it. So, but, you know, the people in St. Louis are starting to look at it as, you know, when you really put the numbers to it actuarially, there's no reason not to take it early. And, you know, because obviously people continue working. Now, if you're not going to continue working, you need to face the fact that what you're getting is what you're getting. And because that number's not going to increase that you took at 62 as except by the cost of living. Any questions? I mean,
I have a question. How many staff members are there at Concordia, Texas?
Total?
Total. Yes.
210.
So, like, in a large church setting where there's multiple staff, and we have all these criterias for making sure our staff members are being good stewards and taking full advantage of housing allowance and those things, do any of you all put anything into place where we're being attentive to that, bringing in a CPA that can deal with the minister of the gospel, tax, housing allowance, and those kinds of things?
I have two of them on retainer that we've used. I'm involved with, well, Pastor 360. I don't know if y'all are familiar with that, but that's where the Pastor 360 is where I've gotten involved and worked with, I think 28 of the pastors involved with that. And this is where this came about through a couple of roundtable discussions and phone calls about, people were upset because the first year I spoke, it was when in May, they were changing the law, and a month later, we got calls, everybody wanted to retire. I mean, I had a 43-year-old that wanted to retire because it was going to change. Well, you know, that wasn't the case for a 43-year-old. But if you made that deadline, you had more options. And now we just have gone on. But yeah, with Concordia, we don't have a formal, but we have people in the congregation that can help them. I mean, I help them a lot of times. The CPAs will work with them because coming out of seminary, we had three pastors that did not do their projection for housing allowance, and so you know they lost out on it completely because you can't go backwards. But the seminary needs to do a better job of educating and well, I mean, just overall money management for that. But yeah, what about, you know, the withholding? You know, a lot of folks aren't used to paying their own quarterly taxes, and that needs to be taught also. That how you go about doing it, how much you put away, and so forth. But on the pension side and the 403B, you know, if you want to, I can put you some numbers together. If you go to that website, there's 3 or 4 pieces on there we have, and also there's other stuff. You can just go on clergy.com has some stuff. One of the articles I have on there has some good information from them on how to do it. But I've done a few for the Baptists, and the Baptists don't have anything. I mean, all they're given is an annuity. And so y'all have the best pension plan there is out there. so the ones we've dealt with in being a Lutheran have just been through Concordia. And everything we do, we run through Concordia, they have to sign off and approve it. So, you know, it's, like I said, now they don't have anything to do with the housing allowance, but on the other part, calculating the benefits, they come straight from them.
I'm gonna check, because what the information I got was age 65 is when you could start doing that in-service.
That was one of the changes on July 1, 14.
That you have to be 65.
You have to be 65, yeah.
Yeah, see, I think that's right now.
Well,
That's why
I'll check into it, but the guys that were calculating it, have calculated 3 of them for us.
since 2014, since the time that change.
We just did them recently. Was compared the numbers run 62 to 67, and or whatever age you want to run in between there. But 65 was just another number that you run on the scale. So I mean, I haven't run any numbers past 67. Nobody's asking them, but yeah, you know, if at 65 somebody's been messing up a lot of paperwork.
Well, I would agree, it's a definite advantage to be able to take your pension and still be actively serving and get, then I would take what you get as income and push that into your 403B so that it's considered housing take, because there's no SICA that's charged on that pension money that comes at 15.3% self-employment tax, you don't pay on pension.
No, that's right, because it's after you've already done it
Right.
up front, so.
So take your salary, and that would lower your salary that you paid at 15.3 on, put that in your 403B and max it out.
There's different ways of,
Yeah, I would have done that a long time ago if I could.
mhm. And, you know, I'll check on the 65, but the guys up there that we've done the ones for.
You know, Jim Sams is here, I mean, he just did a workshop.
Oh,
He's
did he?
the president of
Yeah.
Concordia Plant Services, he just did one here a little while ago.
Okay.
If he's still around, I'd come to that.
Okay. Do y'all have any other questions or anything I can help you with? That's all I have.
Thank you.
Thank
All right,
you,
thank you.
appreciate it.